The first question I ask, okay, well, where does this trade need to go for me to be wrong, right? That's where I will be placing my stop. So if I go long here, this trade maybe needs to go to $9. Just going to make it a round number for argument's sake. That means if I am wrong and I buy a 10, I will lose $1, right? Now, that is the first step I take before any trade. Of course, I have a strategy. Of course, I have setups. I have a focus point on how I think the market will or should move, whatever the case is. But when I get there, I have to protect my downside. And protecting my downside allows me to look at, should I take this trade? Does this trade make sense from a risk perspective? If a trade doesn't make sense in terms of a risk perspective, I won't take the trade, right? So to just go to another example, would you risk $100 to make $1? Now, of course, the $1 is not guaranteed. You have a 50% chance that you will make $1 or 50% chance you will make 100. You most likely will not risk the 100 to make the $1 because it just doesn't make sense. But now, what if I said, would you risk $100 to make $1,000, and you maybe have a 55% chance of being right, for argument's sake, right? Now you'll maybe take the trade. So these two numbers have to make sense of like what you're risking and what your reward is. So when I look at a trade, my first component of, okay, if there's a setup, great, but the setup is not what makes me take the trade. The setup is what kind of ignites me to look at the trade and be interested. The risk component is what attracts me, right? So if I look at this trade from a risk component, I will realize that, okay, I'm risking $1, okay? And also it's not just random. Like I can't just say, well, I'm going to buy this at 10 and I'm going to risk, $1 or $2 because that's what I want to risk on the trade. No, my stop loss, where the trade has to go, and if it goes there I'm wrong, has to make sense. So if I take the same example for argument's sake, let's just say this trade is now at $12. If it's at $12 and I'm like, well, I want to risk $1, and let's just say the dollar is at 11 for argument's sake, I'm still risking $1 on this trade, but if it goes to 11, that doesn't mean I'm wrong. The trade could still be in play. So that's what I'm saying by the trade needs to prove that you're wrong, okay? So just to go back to this example, now when I am looking at this particular trade, once again, I'm risking $1. I have to look at the second factor is, does this trade have room to go up? So for basic examples, basic argument, once again, if I'm buying this at 10 and this does go to 12, I'm basically making $2 if I'm right, and if I'm wrong, I'm essentially risking $1. So in that trade, my potential R is 2 to 1. I'm risking about $1 to potentially make 2. So that's how I look at trades from a risk perspective whenever I take a trade. So if your account size is, let's say, 1,000, I always say go off the 1 or 2% rule. And also keep in mind, this is if you're a beginner. This is if you have not found profitability in your trading. If that's the case, risk 1 to 2% of your account size. Now, if I risk 1%, right, of $1,000, at that point, that is what my risk component should be. So if I look at this particular trade, let's just say 1% is $10. That means I'm allowed to risk $10 on this trade. Now, in retrospect, if I'm risking $10 on this trade, that doesn't mean I only put $10 into the trade. That means because I'm risking $10 on this trade, I can only buy a certain amount of shares or contracts or whatever the case is to only lose $10. I'll show you guys. So if you're buying this at 10, you're buying this stock at 10, and your stop loss is at 9, that means you are risking $1, right? Now, if you are risking $1 and I can only lose $10 per my account size, the most I should be able to buy is 10 shares or 10 contracts. And 10 contracts or 10 shares are essentially going to be $100 in cost. So I'm paying $100, I'm risking $1, and I have 10 shares. That means if I buy 10 shares here at 10 and those 10 shares go to 9, I will only lose $10. That is what I mean by position sizing. That is what I mean by you need to look at your account size. Now, obviously, when you get to a more consistent level, your risk will be altered. There are trades for me personally that I increase my size, increase my risk, depending on the day setups, depending on the market conditions, right? So my risk is not consistent day in and out, week in and out. It has gotten to a point where if I have a high quality setup, I will be more aggressive on risk. If I have been trading well and I have a strong bankroll, meaning a strong amount of capital behind me of profits that I can actually risk in the markets and it makes sense, I will be harder and I will double down on risk. But that is also because I have been profitable for a very long period of time. Now, if I go back to the beginning days, I would keep my risk consistent until I find profitability, and then I would look to alter size. So you also have to understand what stage you are in, okay? Another thing I want to talk about really quick is working capital, right? Meaning capital invested into a trade, and risk, right? So I see a lot of traders, they will see that I've taken a position where I've put $100,000 in, and they're like, well, because he put $100,000 in, he's risking 100,000. No, guys. Just because someone invested 100,000 doesn't mean he or she's risking that. And that's not what you should do. Because as traders, we need to have a stop, or where this trade goes, we will be wrong. We need to factor in what that loss will be, right? So for example, if I buy a trade that is at $10, once again, same concept, and I put my stop at 9, if it goes to 9, I lose $1, right? And let's just say I can buy 100 shares. If I buy 100 shares at 10, that's $1,000 US. That's how much this trade is costing me. This is how much capital is required for me to put into this trade, $1,000. But because I bought 100 shares or 100 contracts or whatever, right? And my stop is at 9, I'm risking $1. So $1 multiplied by my share amount, which is 100, I'm only risking $100. I'm not risking 1,000. Me risking 1,000 is if I don't hit my stop and this trade goes all the way down to 0. So I just wanted to make that clear because a lot of people have a misconception about that. R multiple. So one main thing that everyone should focus on is something called R. So this is something that I focus on a lot. I always say, guys, don't look at the final number of my trades. Look at what I risked to make that trade or make that amount, right? So if you see me make $30,000 or you see anyone make 30 grand, right? The first question is, what did this person risk? If I risked 30,000 to make 30,000, I have a 1R trade. Now, this looks great as a final number, but does it really make sense for me to have 30,000? Does it make sense for me to view this trade as great? Opposed to, let's just say I made $5,000, but I risked $1,000 to make that 5 grand. Now this trade, which is a 5R trade, is a much, much better trade than anything else. So that's why it's really important to understand what you're risking on